Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG29 financing terms. Notes print. Leave a comment. Financing terms. From the beginning of this chapter, we have talked about financing terms, which includes the types of mortgages involved. Financing terms is the second element of comparison and possible adjustment in the sales comparison approach. Our next step is to address cash equivalency. Almost all the time in residential appraisal assignments, we are developing an opinion of market value. Part of the definition of market value addresses the fact that the transaction would take place under normal conditions. Specifically, the definition of market value says, the most probable price, as of a specified date, in cash, or in terms equivalent to cash, or in other precisely revealed terms, for which the specified property rights should sell after reasonable exposure in a competitive market under all conditions requisite to a fair sale, with the buyer and seller each acting prudently, knowledgeably, and for self-interest, and assuming that neither is under undue duress. End of page. Chapter start. 30%. 30%.
Do most properties sell for cash? No. As we know, most real property is purchased with some sort of financing. The good news for the seller is that much of the time, he or she receives cash, that is, a check, at the closing. So most conventional type loans are considered to be terms equivalent to cash since the seller receives the proceeds at closing. From the seller's perspective, it does not matter whether the buyer brings his or her own money to the closing or borrows money from a financial institution. However, sometimes a seller does not receive a check at closing for the full amount, and sometimes the seller provides some sort of atypical financing. So therefore, sometimes we have to try to quantify the cash equivalency of a comparable sale that did not transfer for all cash. The sale may have been consummated under one of the many scenarios that we have addressed. Perhaps it's sold with an FHA mortgage or a VA mortgage, and the seller paid points or closing costs for the buyer. Perhaps there was an assumption of an existing mortgage, or the seller agreed to provide a private mortgage at a below-market interest rate. Maybe there was a wraparound mortgage or second mortgage financing. All of these things could impact the sale price and lead to a price that was different from market value. At that point, the appraiser has two choices: either discard the sale as being atypical or use it and make an adjustment for financing terms.
Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG31 Fannie Mae. Notes print. Leave a comment. Fannie Mae. Section B4-1.3-09 of the Fannie Mae Selling Guide states: sales or financing concessions. The dollar amount of sales or financing concessions paid by the seller must be reported for the comparable sales if the information is reasonably available. See UAD Appendix D, Field, Specific Standardization Requirements, for data entry instructions. Sales or financing data should be obtained from parties associated with the comparable transaction, such as the broker, buyer or seller, or a reliable data source. If information is not available because of legal restrictions or other disclosure-related problems, the appraiser must explain why the information is not available. If the appraisal report form does not provide enough space to discuss this information, the appraiser must make an adjustment for the concessions on the form and include an explanation in an addendum to the appraisal report. The amount of the negative dollar adjustment for each comparable with sales or financing concessions should be equal to any increase in the purchase price of the comparable that the appraiser determines to be attributable to the concessions. The need to make negative dollar adjustments for sales or financing concessions and the amount of the adjustments to the comparable sales is not based on how typical the concessions might be for a segment of the market area. Large sales or financing concessions can be relatively typical in a particular segment of the market and still result in sale prices that reflect more than the value of the real estate. Adjustments based on dollar-for-dollar deductions that are equal to the cost of the concessions to the seller, as a strict cash equivalency approach would dictate, are not appropriate. End of page. Chapter start. 30%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG32 Fannie Mae, continued. Notes print. Leave a comment. Fannie Mae, continued. Regarding adjustments for financing terms and concessions, the Fannie Mae Selling Guide goes on to state. Fannie Mae recognizes that the effect of sales or financing concessions on sales prices can vary with the amount of the concessions and differences in various markets. Adjustments must reflect the difference between what the comparables actually sold for with the sales or financing concessions and what they would have sold for without the concessions, so that the dollar amount of the adjustments will approximate the reaction of the market to the concessions. If the appraiser's analysis determines that the market's reaction is the full amount of the financing concession, a dollar-for-dollar adjustment is acceptable. Positive adjustments for sales or financing concessions are not acceptable. For example, if local common practice or law results in virtually all of the property sellers in the market area paying a 1% loan origination fee for the purchaser, and a property seller in that market did not pay any loan fees or concessions for the purchaser, the sale would be considered as a cash equivalent sale in that market. The appraiser must recognize comparable sales that sold for all cash or with cash equivalent financing, and use them as comparable sales if they are the best indicators of value for the subject property. Such sales also can be useful to the appraiser in determining those costs that are normally paid by sellers as the result of common practice or law in the market area. End of page. Chapter start. 30%.
Financing terms typically impact the interest rate or the payment amount of the mortgage. Sale concessions are usually a one-time charge that can affect the sale price as well. For example, in a slow market or with a seller who is anxious to make a deal, various sale concessions may be employed. Perhaps the only way a buyer could afford the property would be to take an FHA loan, which requires 3 points in addition to the down payment. The seller could agree to pay those 3 points. They may or may not then increase the contract price accordingly. Let's assume that the negotiated price was $100,000 and the buyer and seller are both content with that price. To make the deal work, the contract might be amended to read $103,000. And the seller would agree to rebate the 3 points to the buyer at the closing as a sale concession. If you investigated this transaction and intended to use it as a comparable sale, you could make a $3,000 adjustment in the sales comparison grid for cash equivalency. This means that it really was a $100,000 sale plus a $3,000 sale concession. If the normal type of financing in that market area is conventional, then the sale price of the property under a conventional loan would have been $100,000.
Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG 34 Interested Party Contributions, IPCs. Notes print. Leave a comment. Interested Party Contributions, IPCs. In the Selling Guide, Fannie Mae says, B3-4.1-02, Interested Party Contributions, IPCs. Overview. Interested Party Contributions, IPCs, are costs that are normally the responsibility of the property purchaser that are paid directly or indirectly by someone else who has a financial interest in, or can influence the terms and the sale or transfer of, the subject property. Interested parties to a transaction include, but are not limited to, the property seller, the builder/developer, the real estate agent or broker, or an affiliate, who may benefit from the sale of the property, and or the sale of the property at the highest price possible. A lender or employer is not considered an interested party to a sales transaction unless it is the property seller, or is affiliated with the property seller, or another interested party to the transaction. For Fannie Mae's purposes, an affiliation exists when there is direct common ownership or control by the lender over the interested party, or vice versa, or when there is direct common ownership or control by a third party over both the lender and the interested party. A typical ongoing business relationship, for example, the relationship between a builder and a lender that serves as its financial institution, does not constitute an affiliation. IPCs are either financing concessions or sales concessions. Fannie Mae considers the following to be IPCs. Funds that are paid directly from the interested party to the borrower. Funds that flow from an interested party through a third-party organization, including nonprofit entities, to the borrower. Funds that flow to the transaction on the borrower's behalf from an interested party, including a third-party organization or nonprofit agency, and funds that are donated to a third party, which then provides the money to pay some or all of the closing costs for a specific transaction. A lender credit derived from premium pricing is not considered an IPC, even if the lender is an interested party to the transaction. CB 3-4.1-03, Types of Interested Party Contributions, IPCs, for more information. Fannie Mae does not permit IPCs to be used to make the borrower's down payment, meet financial reserve requirements, or meet minimum borrower contribution requirements. End of page. Chapter start. 30%. Residential sales comparison and income approaches. Help. Documents. Email instructor. CH5 financing terms and cash equivalency. PG 35 interested party contributions, IPCs. Fannie Mae continued. Notes print. Leave a comment. Interested party contributions, IPCs. Fannie Mae continued. IPC limits. The table below provides IPC limits for conventional mortgages. IPCs that exceed these limits are considered sales concessions. The property's sales price must be adjusted downward to reflect the amount of contribution that exceeds the maximum, and the maximum LTV/CLTV ratios must be recalculated using the reduced sales price or appraised value. Occupancy type. LTV/CLTV ratio. Maximum IPC. Principal residence or second home. Greater than 90%. 3%. 75.01% minus 90%. 6%. 75% or less. 9%. Investment property. All CLTV ratios. 2%. Chapter start. 31%.